Welcome back to SF Live. We're still on the road. We're in London. We're here for the Minds and Money conference. My name is Kai Hoffmann. I'm the @JRMining guy on Twitter and the CEO of the Soar Financial Group. Thank you so much for joining us. And we have a bit of a different discussion lined up today again as well. And I like breaking out of our echo chamber, right? We always listen to people like, oh, gold is going to the moon. Gold is doing really well. Silver is going to do great. But let's be realistic. Let's check the counter thesis as well. And I think there's nobody better to invite to the program than Henrik Zeberg. And Henrik, I have to admit, I got to notice you or follow you on Twitter as well as somebody who had ultra bearish gold calls. So I'm really excited that you're on the program, and welcome to SF Live.
Thank you very much. Thank you for having me on.
Yeah, it's great to have you. As I said, I like breaking out of that echo chamber. And before we get to the crux of the discussion, why don't you quickly introduce yourself, and we'll dive into the discussion then.
Sure. So I'm the co-founder of the Zeberg Report. I've created a platform, you could say, on Twitter over the years. I'm a macroeconomist of education. Kind of went into the financial crisis, all leveraged up on within properties, or and got that wrong, and then kind of just said, okay, why wasn't nobody able to actually see this, what was coming, and then I started to develop a model that today is quite comprehensive, works with all sides of the markets, and this is what we use in the Zeberg Report to come up with a macro thesis, you could say, based on charts, based on Elliott waves, but also based on a good understanding of how macroeconomy works, and that's what we do.
Yeah, fantastic. Before we dive in, how much does sentiment play a role?
Oh, sentiment is absolutely extremely important, because Elliott waves, when it comes down to that part of it, that's all about crowd dynamics. And if there's one thing that drives crowd dynamics, that is sentiments. And that's also why people sometimes actually get some of these turning points very, very wrong, because the sentiments are in the extreme side, in the wrong side, and then they do not see that there is actually a turn, and that turn will then make them disbelieve, things again, and they will keep getting it wrong. So sentiment is absolutely important.
Interesting. Let's hold that thought, the sentiment thought, for a minute when we talk about gold. But let's set the macro stage a little bit, right? It seems like inflation is coming down, and it seems like the Fed might step on the rate hike brake a little bit and slow down the rate hikes only to 50 basis points in their next session. Do you want to set the scene for us, like where we're at right now in the global economy, mostly focused on the US, as it is the world dominating, right? It is leading the markets. Like, where are we at right now?
So I think we are at a different place in the business cycle than most people think. I think people think that we are, just standing on the edge of the abyss, and that we are actually believe that we already fall into it. And I think that's very, very wrong. The thing is that we are actually, we see rates peaking, and you do not see rates peaking if you're about to fall into the abyss. What you see is that the rates will come down for a certain amount of time before you actually fall into that abyss. So I am absolutely with you, and also with a lot of people and analysts, that we are going to see a very, very severe downturn. And I actually predict that we're going to have the worst deflationary bust that we have seen ever since 1929. But it's not right now. Right now, the economy is actually running red hot. It is running hot because of the extreme stimulus coming out of all administrations around the world and the central banks. And they actually mistook a supply crisis, the corona crisis, for a demand crisis. So they overstimulated the market with monetary stimulus and with fiscal stimulus, which, when the supply chains are breaking down, creates inflation spike. But there is a difference between short-term inflation spikes and longer-term real inflation, new secular bull market in inflation. And we do not have a bull market in inflation. What we have had a spike because of supply and demand imbalances that are now being sorted out. Supply is coming up, demand is being pushed down because the stimulus is waning, or wearing out simply, and that is going to create the exact opposite side. So the Fed, to me, is just somebody who follows what they see in the macro cycle. And I think actually they are not doing, they've done a terrible job in stimulating, what they did during the corona crisis. But their take on the economy right now, that they have to be a little more hawkish for this time, has been correct. The problem is it's going to be really, really bad because we're going to see a whipsaw now when inflation coming down. Remember, I've been all through this spike in inflation. I've said it's going to be transitory. It's going to be temporary. It's going to see for another, a year or something like that, and then it's going to come down very, very strongly. And we are seeing exactly that now. I mean, I haven't seen the CPI numbers, but that's just a matter of time.
Really, lots of interesting takes on what you just mentioned, Henrik. And I interviewed, I think it was Keith Weiner at the New Orleans conference, and he said it's like a wrecking ball going from both sides of the street, like hitting both sides of the houses on both sides. It's deflation, inflation, keeps bouncing back. Deflation is like, and I listened to one of your interviews recently as well, and I thought like deglobalization, right, and bringing like manufacturing and everything back home, meaning to the US or to Europe, seems inflationary. So it was like, for me, the deflationary scenario as a pragmatics, like I'm not sure I see it. So like, do you want to elaborate on that? Like, why do you think deflation is going to happen with all the macro trends, meaning like deglobalization happening?
I think people overestimate these macro forces that I completely agree with. They are not. There are longer term trends and there are shorter term trends. And I think what we're going to see now is simply that it's not based on what you're talking about here with production coming back home and things like that. What we're going to see is that the deflationary force is created by, and you have to really understand what you're saying, the wrecking ball. The wrecking ball swings out in the inflation because of this misbalance between supply and demand. That everybody is stimulating into a supply crisis that creates inflation because nobody can deliver, and everybody wants something. Everybody's spending that extra buck that they have gotten, from the government or wherever they get it from, lower rates or whatever it was. And then the inflation ball swings out to the right. And what happens then is that everybody is then trying to of course bring up that the supply that they have to meet that demand. And nobody wants to not be able to supply whatever the customers are demanding. And that's when people are starting to build capacity, bringing in people, and so on and so forth. That has been going on until early this year, and even longer into this year here. And then we simply see now that the economy is going to a point where the inflation that then comes out is putting a restraint on the consumer, and then we're starting to see the ball going the other direction because nobody's buying as much more. We see that consumption is coming down and the likes. So we are actually seeing exactly that, but that's on a more micro level than the big things that you're talking about, that production is coming home and all that of that. We are going to see some of that, of course, but that's not in the shorter term perspective. The deflation that I see coming in over the next year or so is created by this wrecking ball that when it turns, it's all the way up here to the right, and now it's going to go all the way to the left side and wreck something else there from another angle, another perspective, right?
What role does the US dollar play in all of this? Because it's come down from its highs. I think the high was 114. The DXY, we're now down to 106. What role does it play? Because I remember discussions not too long ago with the old president, like make America great again. And we need a weaker US dollar to keep the economy going and to keep exporting. Now the US dollar is so strong. Yes, it's cheaper to buy input like raw materials, but it's more expensive to export. Like nobody really buys from the US. It's easier and cheaper probably to buy from Europe right now with a weak euro, for example, right? So yeah. What kind of factor does that play?
So absolutely, the US dollar is pivotal here. It's extreme importance. And actually, if you go back in my tweets for last year, I did predict that we're going to have a tremendous US dollar rally, and we have had that. What I say now is that what we see right now is not the top in it. It's not the real top we have seen yet. We see a correction, and the correction is going to bring us down to 96, 98 on the DXY. But that's not just a correction, because we haven't seen the last of the dollar. And that's actually the last bit of what we're going to see when the dollar is going to strengthen in 2023 into mid-23. Is going to be that deflationary bust. So that plays a tremendous part. So I see that we're going to see a DXY reaching down 96, 98, and then reaching 120 before we get to the final top of it. And that is going to be hugely deflationary, and it's going to hurt a lot of commodities. It's going to hurt gold and silver as well.
Interesting. Yeah, let's table that discussion for a second, because I briefly want to talk about what the Fed is going to do next, because commodities is the next big topic that I want to spend some time on. What do you think the Fed is going to do? And where do you think things are headed now with interest rates probably around 4.5% after this hike session, and mortgage rates increasing. Like, how does that? Like, what's your take on those? On that?
First of all, I want to say again, I see the Fed is playing a secondary role here. I mean, it's
Okay.
the Fed. The Fed follows the market, and the market rates is what really hurts the economy right now. We have seen the rates coming up at a level and a pace that we've never seen before, and this is what creates that has been so tough on the markets, and it has to do with inflation. So when inflation, because of the supply and demand, you then see rates coming up. Inflation and rates are very closely linked. And then you see the Fed actually acting. But if you see when the rates are starting to come up, that is way, way before the Fed started to act. But the Fed follows the market. The Fed will always follow the 2-year yield, the US dollar. So US 2-year yield, I should say. And they will do that again. So when now we see that the longer term rates are starting to drop, and I think that top is in, then we will see the short term rates coming down as well. This means that we've come to the end of the business cycle. And the Fed knows that. The Fed knows that when rates are starting to come down this strongly, it's because the business cycle, the cycle of the economy has come to the top. That does not mean that we fall off the cliff immediately, as I said. That means that we're now in the third cycle. There's a fourth, 1, 2, 3, 4, 5. So 1, 2, 3, 4 cycle of phases that I look at in the business cycle, and we are now in the third one where we are above growth, trend growth, and you can see that on the labor market, but it's starting to decline. And that means that rates are starting to come down, and that means that the Fed will follow. So the Fed will follow the market. We will see a top in the 2-year very soon. I think it may already be in, or very, in days, maximum weeks. And then we're going to see the Fed follow. So the Fed will potentially, and again, because they are a little late, my guess will be that they will not pivot. They will pause, or they will do a little, next time, so 0.25 or 0.5 or whatever, but they will start to ease off, and then they will pause, and then they will cut, and the cut will start coming sometime in 23, late Q1, maybe Q2, could be later. I think it's going to be surprising how strong we're actually going to see this market move here to the upside. And that's why I think there's going to be a longer pause than anybody expects.
Yeah, interesting. I like that you use the word pause, because I've done a lot of interviews and everybody uses pivot a bit differently. Because for me, that's always a drastic change in movement. But also pivot means for some that, as you said, it's a pause. They stop at 4.5 or whatever, 475 475 basis points, right? Interesting comment. Unemployment is the last thing I want to talk about before we talk commodities. 3.6% last I checked in the US. That's for me full employment. Yes, you hear Twitter laying off 10,000s of people, but how does that play a role? And what are you looking for in terms of unemployment rate for a Fed pivot?
Sure. So first of all, you will not see a Fed pivot when you have the employment rate as low as they are right now. The employment, but unemployment rates as low as they are right now, because that's what they're looking for. That's the labor market, and the labor market is actually at this point very strong. That's also why the economy is not in a recession. You do not have this deflationary cycle going. So that's why I don't see the Fed pivot right here. I see them starting to come, to pause, but I'm saying that we are at some point mid next year, it'll be very, very clear that the inflation cycle has gone from very extreme inflation to extreme deflation. We have to consider that all the companies and everybody that's been building capacity will start to lay that off. And then we hear, but the FANG or the text companies are doing that now. But if you actually look at charts and then see how they do it, they do then some, and then they hire them back in, and they'll say the real economy is small and medium-sized companies in the US. It is that in Denmark. It is that in Europe, and that is where the main person is hired. Just because the Twitter and Elon or whatever saying they're laying off some people doesn't mean that the economy is coming to an end. This is where the economy is a super tanker, and yes, Facebook and the likes may be leading some way, but if you look at charts of when they have been laying off people over the years and how employment then have developed, you'll see that they are actually much more volatile. So I also hear that, but I also see that the business cycle has not come to an end. And that's why I'm saying the employment rates are going to come up tremendously high, and we're going to have the worst deflationary bust in 23 into 24. But it's not now. And I think the rates will the unemployment rate will start to come up. We'll start to see fewer jobs created. That's what we normally see. And into the early part of 23. But falling off a cliff right here, no. And that's why they will not pivot. They will hope that they can do this smooth landing, but the wrecking ball will crush it. And that is more of the dynamics of the economy.
Interesting. Very interesting. I want to bring sentiment maybe a bit back into the discussion here as well, and talk about news events that we're seeing globally, right? I just read this morning that China sort of chased off a U.S. cruiser or something off the Taiwanese coast or so. Geopolitical events, right? Like, how do they factor in? Like, coming back to a bit to the deglobalization, like when you do technical analysis, usually news events don't play a role. Like, do you pay attention at all to that? What is happening geopolitically in your analysis?
Often you'll see that some kind of these events will actually mean that people will flock into the direction and say, okay, now gold is going to spike, and then it spikes, and then actually it turns out to be a major top. I think there was an attack on an Iranian facility back in 2019 or something like that. I think I can remember actually quite precisely here. And everybody was saying, okay, now oil is going to go to the moon. And it was actually that was the day of the top. I mean, we see that over and over again. So this about sentiment is always that it's building up to something, and then people get convinced by this, and that's actually the point where everybody is situated in the same side of the boat, and then it's just flips to the other side. So I don't pay a lot of attention to news and to medias and to this kind of thing. We have to understand that the price development of any asset, of any commodity, of anything will consist of hundreds and thousands of variables that influence, and that anybody can just point down and say, okay, this has to do with a cruiser getting chased off. It's ridiculous. Yeah. And of course, the geopolitical situation is important, no doubt about that. But we also see in wars where the stock market has been going up, even though it's wealth destruction. We've seen a lot of that. So it's really down to the business cycle. That's what I see. So I don't pay attention to that. I see when people think, okay, this is very important, but I actually often see that it's related to, when I do my Elliott wave analysis, that it's into the spikes. It's into for such a long time, you could go back in my Twitter feed and look at that. I said what we see in terms of corn and wheat and the like, what the spike in price is going to be, what I call a wave B. A wave A was after the financial crisis, into that drop. Then we have had an extreme point down in a wave B, and now we're going to see wave C, which will actually be very, very deflationary. Nobody gets that. When I said that 2-3 months ago, and I said that in Twitter, because people say, no, because Ukraine, Russia, and all this and this situation. But again, this is how much we can use it for. We cannot use it because when everybody knows it, it's already just factored into the market. So we cannot use these kind of news. It's factored in.
Yeah, no.
So we got to look at it.
Same with natural gas. I was seeing the same thing, like sitting in Germany, right? And everybody was screaming how high natural gas was going. I was like, that sounds like it's a top. All right, and natural gas prices have declined since as well. You made the segue perfect to commodities. Let's talk commodities and commodities crashing. How do you predict? Let's start with base metals maybe, and sort of build up some tension here leading up to the precious. But how do you see base metals then developing as well now over the next 6 to 12 months then?
See, if you look at copper, I actually think copper is going to do well here. I think we're going to see a nasty move up, and that's also based on the fact that copper is actually something that you will see. We call it Dr. Copper, and it has to do with the fact that it's utilized in a lot of production and in the real economy. So I think we're going to see that in this next move up in the market here, we're actually going to see a bounce in the economy. I don't think a lot of people will predict that right now, but I think we're going to see that. Every bad thing has been factored in already now, right? So I think we're going to see that. I think there may be smaller bounces to other base materials also, but going into 23 and 24, there's going to be a massive decline. So copper will have a new high, and I think it's going to be an all-time high. But then you're going to see a massive crash, and this is where I think when we get to when we both look at copper and we look at also precious metals, which I probably think you're going to talk about later on here, that I don't think people understand that, the impact of what's going to happen when this wrecking ball of the inflation deflation cycle is going to swing to the other side. I mean, this is few seem to have forgotten also what happens during the financial crisis, but something is going to happen. I mean, I don't know what the media is going to call us at, whatever brought it about. And I know that some called it was the Lehman Brothers back in 2008, but it's actually the crisis was actually already developing at that point. So what will bring about this major deflationary impulse that I see in my charts, that I see in copper, that I see in emerging markets? I'm not quite sure, but copper will take a tremendous tumble, and base metals are the same, and the same will also precious metal. But that's the deflationary scenario that people simply cannot take in until the moment it is actually there, and then it will just fill everything they see, and then that's why also people so right now they see inflation because we've been in an inflationary, and people they just project on what they see, and they don't see the turning points. That's where Elliott wave actually is fantastic if you utilize it in the correct manner, and that's why I also have multiple charts. I have hundreds of charts which does not just individually point to some of this. It's actually something that is a big model where they all go in and provide a piece of the puzzle, and you can't have the dollar spiking without also seeing something in oil and the like. So there will be connections between the different charts of the hundreds that I have in my model, and that's why I say base metals, precious metals, and the like are going to see a tremendous tumble. And I actually think when it comes to precious metals, it already has seen the top.
Interesting. So the top 20, I think it was 2080, I think, right? Right around there, 2068, I think, was the top for gold. You threw precious metals sort of together, gold and silver. Do you look at them differently? Do you treat them differently, or are they the same for you?
Gold and silver is the same for me. That's absolutely the same for me. That's they follow the same kind of cycle. They had a spike in 2012. Then they had the kind of a decline for some time, which is what was my wave A again. Then they've had a spike, and we saw gold spiking into August of 2020. And it hasn't been any higher ever since, even though I was told at that point that gold can only go one direction now, and that's up, because inflation is here. Yes, inflation is here. And even though we've been told, which I do not sign into, that we have had stagflation, which we haven't. It's not been stagflation because the stagflation would require that the economy was actually in a real recession, which is not what we've seen. Then we have had a decline in gold, even though inflation is up. How can that be? How can that be? And the only real explanation to that is that the economy has been going through a supply and demand imbalance that is not a real inflation. But the moment the real inflation sets in, and it will come, but we need still to have that deflationary sell-off. The moment the real inflation sets in, you're going to see gold go much, much higher. And then, say 15,000, 20,000, we can go much higher. And silver, I don't know, 300. You can go much, much, much higher with that over the next cycle, depending, of course, over how many years. But I do anticipate and expect a stagflationary phase that is going to play out after the fact, or that when the Fed moves in again, but that's down 23, 24. So a stagflation phase, a real stagflation, where the economy is still in the slump or slumping, and you got the Fed moving in with stimulus, and you got administration moving in with that, will be bad. Will be really, really bad, and they will cause the worst stagflation we remember, and it's going to be really bad. And I fear, honestly, for the societal fallout of this, because one thing is that prices are going up, like we have seen over the last year, but the moment that people also start to lose their jobs, and we have this, then you got real problems.
Yeah, I remember seeing movies from the 30s as well, where people are just going crazy. Those images are vividly in my head for some reason. Being German as well, with the hyperinflation back then, it was just insane, right?
Oh, yeah,
it's imprinted in our DNA. The reason I ask you why you threw precious metals together is sort of, I've seen, or it feels like my gut tells me we've seen more of a decoupling of gold and silver. Silver going more the industrial side, being more used in solar panels and things like that. That's why I asked whether you saw sort of the same trend. Like, I wouldn't say the same trend.
I don't see that. I don't see that, and I see huge bottom coming to both of them at that point, that moment, and that's why we also have a silver and gold miners report, because we say that when you reach that point and you have the patience to understand that we need to go full cycle on the business cycle before you actually get to that bottom, you will see tremendous, returns.
Creation. Yeah, exactly.
Returns. What on getting long at the right point, but that's not now. That's not into a cooling economy. That's not what you want to see. That's not the point when gold and silver is doing well. And if you look at it back in 2008, you actually had from I think February and March of 2008 into September, you actually had a 30% drop in gold. And I think you're going to have much more this time. Remember again, debt is higher and so on and so forth. And also my Fibonacci extensions that I use as part of the Elliott wave is suggesting much lower levels. I still got 890 to 960 on gold, potential at 1200 mark. Also, if it depends on which structure it takes. But that's a lot lower than where we stand today, and but 1200 could also be the level. But these levels and GDX will go below $10.
Oh yeah, that'd be awful because we haven't been treated to any real wins lately. Anyway, you mentioned you have the gold and silver miner report. Like, what are you sort of recommending right now? Like, or is it just a bit of a cheeky question? Are you sending out just patience, hold, wait? Like, what's in there? What are you recommending right now? You don't have to share names if you don't want to.
No, that's fine. That's fine. No, so we just say that we think that we're gonna have a tremendous opportunity to buy into this. I mean, I just heard for the last 8 years that now it's the time. Now it's the time. Everybody's telling us now it's the time. And to 2012 also when they reached 2013, when they had a bottom or. It's the time. And yes, short term, it's the time. It has been time maybe many times over the years. What I'm saying is that the secular bottom in miners and in gold and silver, but also in the miners, is going to come. And that's going to come when the business cycle is right. And the business cycle is not right going into deflationary bust. That's not where you want to own silver and gold. You have to remember the primary reason why you will hold gold is because gold has the finest job, the finest thing that gold can do is to provide liquidity when liquidity is needed. That's why you hold gold by the end of the day. Because it doesn't do anything else, but it's because everybody, there's always somebody who will give you but it does that in a deflationary bust by getting sold off. And that's why you're going to see, because in the deflationary bust you're going to see a lot of institution getting into problems. I foresee, I said this also a few years back, I see that during that deflationary bust we're going to see pension funds going to get into trouble. We already see that now, but just you wait for the right circulation to set in. Sorry, and then also you're going to see countries getting into problem. You're going to see corporate, corporations coming into problem. So there's going to be a lot of need for liquidity at a moment where we have a deflationary bust, just like what we saw during the financial crisis. And that is why gold is being sold off until the moment that the solution is here. And back in 2008, the bottom was in on gold in October of 2008. That was because the geniuses of the Fed came out and said, okay, we're going to print ourselves out of this. This time around, they will come up with something similar. They will print again, and they will expand their balance sheets, and they will reach 30 trillion or something on the balance sheet. And gold will like that a lot. But it's not the time to buy into it when you have the economy rolling over. That's a misunderstanding, because it needs to fulfill its finest task, which is to provide liquidity.
And just to recap, like you mentioned, Q2, Q3 next year might be around that time. Is that sort of what I took from the conversation?
That's what I got some. Yeah, we got some extensions. I would say that there are more the levels that I follow that are based on some Fibonacci extensions that I do, and there are a lot of things suggesting that we could get this in. And I'm I always look at the charts and I get some intersections between Fibonacci levels and between some timelines and trend lines and so on. And then I say, okay, so if we look at all of these, the hundreds of charts, and then say, what is the most likely time span we got? Then I say from now on, and actually a few months back, we already got the bottom in the stock market. And we're going to see that tremendous rally now over the next coming weeks here and months and into early next year. And it'll be unbelievable, and everybody will get into it, and people will just be, the FOMO all over the place. The thing is, this will be the final blow off. This will be the final, hooray in this business cycle. As the business cycle then turns over, we're going to see really hard fallouts in terms of, okay, people thought they bought into value, but they did not, and they're going to lose a lot of money, and that will be part of the deflationary bust that they will then take on in force. And that brings us in as at least into mid of 23, at least. I mean, that I can see that this upturn in the market could last longer, but I see some kind of evidence that we could see a bottom in gold and silver sometimes during next year. And the bottom in gold and silver will only be at the point when, again, the solution from the geniuses is going to be here. This time around, I think it's going to be debt forgiveness, debt restructuring that is going to bring it about, and more helicopter money also, I think. So they're going to try to stop the deflationary bust by doing some of that, and we hear that now with the student debt forgiveness plans. So they have aired or talked about, and it's going to be more and more widespread around the world. And this will set the world off on a new, what I call inflationary cycle, and a secular inflationary cycle. And in 10 years' time, the rates that we have had now over the last couple of years and what we're going to see will be something quite different. And the inflation rate will not get hyperinflation, or I heard this also. We'll get high inflation rates, meaning 3, 4, 5, 6, 7% even. And it'll be for uncomfortably high for an amount of time. And so it will feel bad, but it's actually going to inflate the rest of the debt away. And that's why the rebirth of a new economy, and you can say that's what you had also coming out of the Second World War. You actually had deflationary bust during that, a lot of wealth destruction, the rebirth of the economy, and then you saw that the build of a new economy or of a new regime. That's what we're going to see. The similar kind of like that is what I see.
Interesting. It's like inflation, like inflating the debt away, though. Even at where somebody mentioned at 5 or 8%, I think it was 8%. It would take 40 years to inflate the debt away. All right. I heard, it's like, don't quote me on it, but it was a very long time frame. I didn't want to go there. I didn't want to go there, but one last question popped into my head. Like, sort of, how does the whole crypto sort of disaster that's happening right now play into your forecasts? Does that factor in at all, or is that too small of a market to have an overall impact?
No, but actually, I mean, I'm mostly, amazed to see how many people who has been fooled by this. I mean, last year, I said on September, I got a tweet from September saying Bitcoin could fall to, and I said I put it to around 5 to 10,000 on the Fibonacci extensions. It made one more high after that. I give that, but the chart was pretty darn, correct in terms of seeing that kind of level. Okay, it's only at 16,000 now, so I'll take it if it drops to 16,000, but I did say a large drop. I also said that a lot of cryptos are going to get absolutely destroyed. And then I'm going to say now, I actually don't think this is the big thing. This is not the big one. This is the crash that will just do the first shaking, and then we're going to see another move up higher in cryptos, because we have to remember that the last part of a bubble is going to be extreme FOMO. And if there's going to one place there will be FOMO and based on nothing, based on no value, there are Doge and Titcoin and whatever they all called, they have absolutely no value. And if you study tulip crisis and whatever have you, they were also talking about black tulips versus other tulips back then, 400 years ago. We haven't, we're not brighter today than they were back then, even though we might think so. And this time around, all the crypto experts and this crypto might be better than this one. Crypto has the blockchain technology, and the blockchain technology is what is important. It's not the DeFi, as I see it. The DeFi discussion and argument is simply naive, because there's no way they're going to anybody. It's going to allow a decentralized exchange rail, crypto to dominate the world. Simply too much at stake. It's the geopolitical game and so on. So that's not going to happen. But can we see that some of the crypto? We will see some of these cryptos actually develop into something which is quite extraordinary when they get into business solutions. And that is the point, I think, where you'll see the real crypto stand up. The rest of them, that will be like tulips. It's digital tulips, 99.99% of them.
Digital tulips, I like that. Yeah, I don't think I've heard that term yet. So fantastic. Henrik, wonderful conversation. I really appreciate it, quite refreshing, and appreciate your time. Thanks so much for coming on. Where can we find more of you?
Well, so yeah, Twitter is my place at Henrik Zeberg, and also we got the Report.com, where we have a weekly live show and people can ask questions on the live show, and also do chart requests. And I will give a picture of the general macroeconomic picture, and also an idea of when and how to what to jump into when the tide turns.
Fantastic. Yeah, we'll link to all of that in the description below, so make sure to check that out as well. Henrik, thank you so much for your time. Really appreciate it. Can't wait to maybe in Q2, like mid Q2, we should definitely catch up again, see how the whole scenario is playing out. I think it'd be really interesting.
Yes.
Fantastic. Everybody else, thank you so much for tuning in. We hope you enjoyed this episode of SF Live. We were joined by Henrik Zeberg of the Zeberg Report. Make sure to follow him below. Check out his Twitter and, of course, the Zeberg Report as well. Leave a comment, leave a like, and, of course, subscribe to the channel. We always want to hear from you, and we got lots more planned, of course, as well. Thank you so much for tuning in.